Cash, 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 cash. We all want cash, dude. Cash, cash, cash. I cannot. I'm a broken record. I just got off the phone not once but twice today with AT&T employees, by the way. And yeah, so AT&T is still kicking ass and taking names when it comes to their employees. Both these guys are crushing, just kicking ass and taking names. So what I tell these folks to do, both these kind of folks. All right, I'm trying to get it so you can see. I got to change this around. I want you to be able to see my beautiful, beautiful pearly yellows. So this case is actually a woman. Now her husband's AT&T. She's not, but she retired last year. She got about $400,000 in various accounts at other firms. I said, just consolidate at Fidelity, man, and because they like Fidelity. And the other guy's the same kind of thing. I was like, look, just put it in the cash account, the SPACs. So Vanguard's got. I can't remember the Vanguard ticker symbol, and I can't remember the Schwab. I think Vanguard is VEFM. No, VEFM. No, I can't remember. The Vanguard Federal Money Market, but in this case, Fidelity is SPACs. All right, and basically it's government, short-term government bonds, government repurchases, short-term treasuries. Vanguard. Well, let's take a look at Vanguard one sec. So here's a Vanguard, 5.3 is the SEC yield right now. Expense ratio is 11 basis points. Let's see what the holdings are. All U.S. government debt, which is exactly where we want to be. Let's just see specific holdings. I think it shows us here. 174 holdings, average weighted life 46 days, average maturity 17 days. Crazy, man. Yeah, they got repurchase agreements in here too. Repurchase agreements, U.S. government obligations, U.S. Treasury bills. All right, so that's pretty good. So that's 5.3 at the Vanguard. Fidelity one is SPACs. And here's Fidelity one. It's only paying 5%. Why is it paying so much less? Because that's a higher expense ratio, which I thought was right there, 42 basis points. So there you go. So the expense ratio of Fidelity is 0.42. The expense ratio of Vanguard is 0.11. Vanguard pays 30 basis points more than Fidelity. That's just a fact. So, you're paying Fidelity and as opposed to you getting that money. Is it worth it? I mean, whatever. I mean, it depends. I mean, I'm telling you, yes, it is worth it. But at the end of the day, if you like Fidelity, well, you got to pay for something. So they're getting more off the money market than you're getting. And all their funds are going to be more expensive by and large than Vanguard's. Would that give you access to better customer service? Maybe. They have more employees, I presume, because they can pay them because they make more money. But that's what you got to pay for something. Anyway, be that as it may, they got right here 46% repurchase, floating rate, T-bills right there. So close to the same kind of fixed rate securities. Are these explicitly 100% short-term stuff in terms of stuff that matures every day, every 17 days or so? I can't tell you exactly how the repurchase stuff works, but I'm very, very comfortable with both these guys. Let's see what the Schwab one is. All right, I think this is I got the SWVXX, 34 is the basis points, the expense. Right, show the yield on this guy? Where's the yield here? Right now it's, what is the yield on this guy? Hold on a second. So 5.25. So it's going to be a little bit more aggressive than Fidelity in terms of the holdings that it has. See portfolio. View portfolio holdings right here. They'll be a little bit more aggressive than both those other ones because there's a high expense ratio relative to Fidelity and Vanguard, and it pays a higher yield than Fidelity. Let's make this a little bit bigger so we can actually see. And so they have they got commercial paper in here, so they're going to be more aggressive by far than those other two right there. Anyway, so of my three, I'd take the Vanguard for sure. Then I'd take Fidelity and Schwab. I got Schwab just because I'm not all that worried about this going bankrupt or anything. Just not. But anyway, you could be, and you say, okay, I'm going to buy the Fidelity one or the Vanguard one. So completely up to you. I'm fine either way. All right, but check this out. So if we take this, is what everyone always says, but what if the interest rates drop, Josh? And actually, I get it because right now they're paying based on average 5%. So let's say let me get my other marker here, and you guys can still hear me. How cool is that? Because I got my portable mic with that. All right, so Georgia Tech and Georgia. Who you got? Georgia Tech and Georgia. Let's go Tech, baby. Let's go Tech. Let's beat those SEC boys. Come on, that's tomorrow. So here we got $400,000 in cash. And we're going to say at 5%, that's 20,000 schmackaroonies a year of interest without touching the principal. That's an at 5%. 20,000 a year smackaroonies without touching the principal. So everyone, so we can take 20,000 and not touch the principal. All right. So let's just say this drops to 2.5. $400,000 at 2.5. That's $10,000 a year. So now we're like, oh my goodness, see, Josh, that was a bad investment because now I'm only making half what I was before. So let's think about what happened to make the interest rates drop. What would happen to make the interest rates drop? Well, most likely economic output is going down. Output drops. All right. Why would they lower interest rates if economic output? Now, they could lower interest rates just, I mean, I don't think they'll do this, but let's just say economic output stays flat. Would they lower interest rates? Yeah, they might because the federal government doesn't want to pay so much interest. Generally speaking, if inflation is still a concern, they're not going to do that because for some reason economics has been able to convince everybody that the interest rates is what drives inflation. It's so dumb, but okay, we'll go with it. So they're not going to lower interest rates while they still have inflationary concerns. They're just not going to do that because they say we don't want to increase growth to stimulate the economy with cheaper debt. As such, we'll be right back to where we were. So most likely, if economic output stays flat, they're going to keep the interest rates where they are for the foreseeable future. If economic output keeps going up, they'll probably raise the rates. All right, and that'd be good. We'll get 5.5% and 6%. I'll take that. But most likely, the reason they drop the interest rates is economic output drops. All right. Now, what happens when economic output drops? What happens to the stock market? You want to take a guess? You think the stock market would go gangbusters if economic output drops? No, the stock market drops too. Remember, what's the stock market? What is it? It's a projection of future earnings. That's what stocks are. They say, look, we think in the future earnings are going to be lower than they are today. Thus, there's going to be a sell-off. And it's insane how prescient the market as a whole is. They say things don't look good. We think 6 months from now, the economic output will drop and earnings will drop. So we're going to sell today in anticipation of that. Are they always right? Of course not. But they seem to be right a hell of a lot more right than they're wrong, that's for sure. So now economic output has dropped. The earnings have forecasts have dropped, and then outright earnings have dropped too. But you don't want to, you want to be out of there if you're going to be day trading, buying and selling. You don't want to be in stocks when the earnings calls have already happened. You want to be out of there before that happens. This is where the prognostications come in. They say, we think earnings potential looks bad, so we're going to pull back on our stock holdings, and you'll see a market decline. And then 3 to 6 months from now, the earnings will become almost like, it's crazy, almost like the sun rises in the west, sun rises in the east. Say, weird. 3 to 6 months ago, people were expecting earnings, the earnings were still fine, people were expecting earnings to drop, and the stock market fell, and fast forward 3 to 6 months, and now all of a sudden, earnings reports are coming back in pretty negative. I tell you, these guys are good, man. These forecasters and whatnot. It's not any individual, it's the market as a whole. Kind of like who does a 538, the aggregate of the polls. Now, look, most polls are corrupt Democrats. We know this. But at the end of the day, they still have to try to make a game out of it. They still got to try to look good. So they'll put some corrupt poll in there. And, 2016, that Hillary Clinton, or who was it, even in 2020, but Hillary Clinton's winning by 13% in the CNN poll. And everyone knew that was just stupid, man. Biden's up by 20% or something like that. Everybody knew that's stupid. And they did that back in like September. The closer you get to election day, the tighter the polls get. Not because the voters have changed their mind, but because they do a lot more thorough analysis of the polls. That's just how it works. So that way, at the end of the day, they can say, look, on November 4th, we had our poll, 51-49 Trump over Biden. And, but a month ago, they had it 58-42 Biden over Trump. So how'd that change? The consumer or the voter change that much? The voters don't change. No, it's just a poll. They surveyed better. They had a better better N. N is a surveillance. So who are you surveying? Well, before they're surveying, friggin' anyone could wipe, friggin' take a grump in the woods. Now they're going to survey likely voters. They're going to do a lot more efficiently. They're not going to overwhelm for Democrats and all that stuff. They'll say, it's a 40-40-20 mix of 45% men. They'll have a lot more white men represented than they did before. It was like mostly black women and stuff like that. So it'll be a tighter survey, which means it'll be more legit. It happens all the time. It's amazing how that works. And the same thing here. So basically, are they always right when they say, look, we think earnings are going to drop, and as such, we're going to get out of the market a little bit? No, but there's right a whole lot more than they're wrong. It's actually, if you follow this, you'll see the market start to go down. You say, man, that must mean 3 to 6 months from now, the earnings are going to drop. 3 to 6 months, they start showing negative earnings reports, and you're like, well, I can't sell now. The market's already tanked 20%. It's interesting, too, because what happened last go-around, 3 to 6 months later, the market flew up, and that's when the negative earnings were. You're like, why is the market going up when the earnings have come back negative? Oh, because it's already been filtered in there. They already took their market decline from the bear market last year. It's pretty interesting. All right, so now right now we're at 400,000 at 2.5%. So we dodged this stock market decline, which is great. So stock market went down. All right, economic output fell. Stock market went down, and however it works. We're sitting in cash. Interest rates then drop to 2.5. So what happened to our portfolio? Did it fall 20%? No. So what do? We take some, we go on in there. Because now we have all this cash on the side that had nothing, that was not losing. Yeah, we're not making as much, but not making as much is a hell of a lot different than losing, that's for sure. So I got $400,000. I was getting 5, I'm getting 2.5. I can go in here. What happens to my dividend yield? Always remember, dividend yield or what? How do you figure out dividend yield? All right. Dividend yield is very easy. It's price over dividend payout. All right, so again, we're going to take a $10 stock, and it's got a $2 dividend. All right, our yield is 20%. How do we get that yield? We take, I always forget what goes on top. It's the dividend over the price, 20%. That's how you figure out the dividend yield. Isn't that right? 10 over. I always forget. No, because if it's price over dividend, it'd be 50. Yeah, so that's how you do it. So you figure, let me just make sure I got 2 divided by 10. That's it. So that's how you figure out your dividend yield. All right, so now that's the $10 stock dropped to 5. We'll just say still got a $2 dividend. So now it's 2 over 5. So 40% dividend yield. Dividend yield went up by, stock fell by 50%. Dividend yield went up by 50%. But Josh, they're going to decline. They're going to reduce their dividends. Okay, and let's say they reduce their dividends. Right? They reduce their dividend to 1.5. That's a 25% reduction in dividend. Share price fell to 5. All right? 5 is the share price. 1.5 is the dividend. What does that give us? I don't know. 33%, I think. 0.33% dividend yield. So dividend yield, that's if the dividend drops. That's the dividend drop by 25%, which is a pretty significant drop in dividend yield. Price of 50% happens to stocks all the time. So now we have all this cash that's paying us less, but now we can go in stocks that are down 10 to 5 or whatever the price is and getting a much higher dividend yield. The dividend might be lower, but the dividend yield is much higher. You always want to buy stocks with a higher dividend yield. Why do stocks have a higher dividend yield? Because the price has dropped. Come here, baby. Here comes old Pablo. I know. You want to say hello. Come here, the dog man. Come here. Oh, we're going to show you guys Pablo. Here he is. Pablo. All right. Pablo loves when we talk about dividend yields. Look at this guy. There he is. Hello, everybody. My name's Pablo. My name is Pablo. I live on the 2nd floor. Hi. Do you know what I like to do? I like to bark. I like to lay in my dad's lap. And I like to smoke meth. Look at my meth teeth. We love you, Pablo. Yes, we do. All right. Anyway, so cash. Especially if you're about to retire, dude. This is the time, man. I'm not saying you put everything in there. I'm not telling everybody to put all the pennies in cash. I'm just saying, man, that big exposure to cash is tough to go wrong right now. All right. I love to hear your thoughts. We'll see you